the number of people that have been part of a high growth software company that has gotten to critical mass and had some real size and heft to it and hopefully some exit is fewer and farther between than I would have hoped.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Podcast Guest List himself, Eric Hornung.
I think that there are a few companies trying to solve this IMDb for podcasting space where it makes it much more searchable for podcasts and podcasters and podcast guests and topics. And you see Google getting into it. And there's just a lot of discoverability around podcasts that seems to be a focus right now in the space. Nothing has worked as well as just manually creating guest lists on our favorite podcast app, Breaker, and then sending it around. So I made a J. Klaus podcast guest playlist. I just made one for our friend Alex Rubalcava. And going forward, I think I'm going to do it for guests of the show who've been on other podcasts.
It's a delightful little asset, and maybe you should just make it a little side hustle for yourself, Eric, to say, hey, you pay me $20. I categorize all the shows you've been on.
It takes about 7 minutes.
So that's almost $120 an hour.
I'm worth it, Jay.
Billable hours. I'm sure your billable is much higher than that.
I think the benefit is really just the shareability of it. So if I hear someone on a podcast who I think is interesting, if I listen to Alex Rubalcava on Meb Faber's show, then I can jump into his kind of podcast playlist of all of the podcasts he's been on and learn about him over time. I think that is almost like reading a book about somebody or that somebody wrote.
How can guests of the show check out the playlists that you've made for our guests so far?
Well, we share them on Twitter. I don't know that we store them anywhere else. Except for if you go to Breaker and you find me, I am EK Hornung, and they go to my public playlists, they will see any guest lists we've made to date.
Well, today we're adding a new guest to our fold, as we do every week, with Greg Robinson, the managing director of 4490 Ventures. 4490 Ventures is a technology-focused early-stage venture fund based in Madison, Wisconsin. The fund seeks to invest in companies in the Midwest. It puts between $5 million and $8 million per investment and was founded in 2014.
I guess I'm going to have to make Greg a podcast playlist.
2014 seems to be a good mint year for venture capitalists jumping into the Midwest.
I wonder why that is. Do you have any hypotheses?
I'm not sure, but what we do hear from folks who are focused on the Midwest and aren't in Chicago, and maybe even in Chicago, we just haven't had enough context there, is that most of them started looking eastward or westward, depending on where they started, but towards the middle of the country, sometime around the 2013-2014 time frame. Probably looked really crazy then, and now as we're talking to them and they seem smart, they're all telling us about the same date. Greg has a blend of venture capital investing and startup operational experience. He was a managing director at the Palo Alto-based Peninsula Ventures and a co-founder and COO of Cogent Technologies, which was an enterprise software company that successfully exited via acquisition to a publicly traded company. He's invested in approximately 20 early-stage startups over his career and has an MBA from the Tuck School of Business at Dartmouth.
I've talked to a few venture capitalists who are in the Midwest or the middle of the country and came from Silicon Valley. I mean, this is Palo Alto. This is like the heart of Silicon Valley. And it always seems like they have really good processes or like very specific things that they do that you don't read about in the general how to be a venture capitalist books. So I'm interested to see what Greg's kind of differentiator is here.
Well, we're about to find out. And as we go through this interview, dear listener, You can tweet at us your thoughts at UpsideFM or email us hello@upside.fm. We'd love to hear what you're thinking, and we'll get into that interview with Greg right after this. Eric, what is your favorite kind of pie?
Oh, dude, apple pie all day. Also, I'm kind of on the fence between apple pie and apple crumble, and are they the same thing or are they different? Either way, they're both delicious. A little scoop of vanilla ice cream, caramel. I bet you didn't think you were going to get that much of an answer from me on that one.
A lot of detail, so I want you to imagine a pie chart, and we'll even make it an apple pie chart. Let's cut that apple pie in half. 50% of it is technical recruiting, 25% of it is executive search, and 25% of it is sales, marketing, and product. That is the breakdown of the different types of searches done by our friends over at Integrity Power Search, the #1 full-stack, high-growth startup recruiting firm between the coasts. They partner with venture capitalists, private equity groups, and CEOs to build amazing teams for the world's most disrupting companies. 50% of their searches are technical recruiting, 25% executive search, and 25% sales, marketing, and product. So if you are hiring, dear listener, I would get a hold of Integrity Power Search.
How would you do that, Jay?
Just go to upside.fm/integrity to learn more about what they do and how you can get involved. That's upside.fm/integrity.
It seems to me like you led with pie, and I don't get any pie. Am I losing on this one?
You are getting no real pie. It was simply a visualization. Greg, welcome to the show.
Thanks for having me.
On Upside, we like to start with a background of the guest. Can you tell us about the history of Greg?
Sure. My background is primarily I've always been involved with software, first on the creation side of it, and quickly realized that I wasn't nearly as talented as other people, and I needed to find a different way to utilize that. And so I went more on the entrepreneurial side. Was fortunate enough to start an enterprise software and services company that we built up, and after doing that for a number of years, sold it to a company that just gone public. And at a fairly young age, felt I was probably overly smarter than I really was, and all of the things that young, overconfident young men do. So
that's right where Eric and I are right now.
Yeah, exactly. It's a beautiful.
Except we haven't exited to a public company.
But it's a beautiful time of life. It's just you're just overconfident and happy about everything. But after that, I decided that maybe it was time for me to go on the investing side, and so made my way out to the Bay Area and started my career on the investing side. Joined up with some guys at Peninsula Ventures, and we basically did early stage, kind of classic venture, early stage, capital efficient software investing, and was out there for the better part of a decade and a half. Had a great time, loved the Bay Area, but like most people, after a decade of doing something, kind of get an itch to do something different. And so that led to kind of the point in my career where I started contemplating, could I do what I do, but do it somewhere differently? That sounded like an interesting challenge. Through that process, ended up in Madison, Wisconsin, where I started 4490 Ventures about 5 years ago, trying to take a lot of the learnings that I had from my work in the Bay Area and applying that to really a different geography, which changed the game dramatically. And so provided in some ways a familiar opportunity set, but in a very different way. And so it was kind of felt brand new and exciting. And so been doing that for about 5 years now.
How'd you come up with the idea as a young guy for an enterprise software play?
My first job was with Anderson Consulting out of school, where we did big enterprise systems, and so got a flavor for what that looked like. And while appreciated working with these Fortune 500 companies and kind of large production systems, didn't love the mass of things and the pace of things. And so kind of took what I saw, the needs and the capabilities out there, and tried to apply that to what I would consider kind of more of a mid-market opportunity set, which would basically translate into smaller customers, more nimble customers, more dynamic solutions and products and things of that nature, which was more in line with what I wanted to do, and was really part of the evolution of kind of going from kind of the big enterprise to mid-market to eventually going on the investing side, which was really more about getting to the startup side of things, where things were even smaller, more nimble, more dynamic, and from my perspective, more interesting.
What were some of the high level learnings or takeaways you had from running and selling a company that keeps creeping up now, working with entrepreneurs on the other side of the table?
One of the most important lessons I think I learned early on was kind of the difficulty and also the benefit of being capital constrained. You always wish you had more money to do more things and build more stuff and hire more people, and you think that would make your life better and your product better and ultimately much more successful. And what I found is that when lots of money gets thrown around early on, you can't do all those things, and it makes for lots of expensive mistakes versus just a few smaller, cheaper mistakes. And I think it also provides cover, or at least facilitates kind of a culture where you don't have to make some of those hard decisions, and you don't have to be as focused. And I think those things, once they're set, are hard to really change. And so that's one of the reasons why I like the model that we employ, which is a little bit more on the capital efficiency side of things, at least on the early stage. I mean, there are certain stages once you get product market fit and you really know what your go-to-market strategy can be. Sometimes it does make a lot of sense to raise a lot of money and to really go in mass after the opportunity. But I feel like in the early days, there's just a huge benefit to being capital efficient and building that culture and building that mindset that can yield some huge results and huge benefits later on.
So you were a successful entrepreneur who exited his business. If you would have went back to investors instead of going to the VC route, you likely could have raised a lot of money. I know this is maybe a little bit of the narrative fallacy, but do you think you would have retained that capital constraint philosophy?
I don't know. I think I was in some ways, because of, we were young, first time entrepreneurs, access to capital was harder, as we all know. If you're not surrounded by lots of firms with lots of money, it's really, really hard. So, I didn't have that luxury. I'd like to think that I would have been somewhat predisposed to be capital efficient, but I know other people that around that same time were part of groups that raised a ton of money, and I kind of saw firsthand how that played out in a very destructive way. And I would have thought that they would have been fairly rational about things as well. I think it's just, we're products of our environment in many ways, and sometimes we think we're good, and sometimes we're just it's luck, and it's just circumstances that you're placed in. And so I think that I'm a product of that experience, and I in retrospect developed a strong belief around it. I don't know if I could have raised money, I probably would have, and it probably would have changed my outcome. I don't know if it would have been better or worse. It would have changed it, and I probably would have a different perspective on capital efficiency today.
Doing a software company something 8 or 10 years ago, software has changed a lot to today with the companies that you're investing in. Are there any disconnects to that, or does it map pretty well to your experience?
Yeah, so I think the good news about software today is that, unlike before, where you had to raise a fair amount of money to actually get your product up and going to where you can start to do customer investigation, now you can actually, for hundreds of dollars and days, if not weeks of time, you can stand up your product and spend the bulk of your time and money really exploring the voice of the customer, the market need, and really tailoring your solution to what the customer needs, versus building out this big, expensive infrastructure that was table stakes. You had to do it, but really didn't provide a lot of value. So I think that as a result of that, you're seeing a lot of people that otherwise didn't have access to capital 10 or 15 years ago start companies. You're seeing them spend a lot more time focused on product market fit, which I think is great. The downside is you're getting a lot more companies being started and a lot more competition. So if it's kind of an obvious opportunity set, there's going to be 10x the number of entrepreneurs that are going to go after that, and that just waters down the opportunity, largely speaking. And so I think from an entrepreneur's perspective, you have to be thoughtful now of if you go after something and you get feedback from the market that this is going to be tough, or you can't execute against the opportunity, that you need to be I think just self-aware and willing to shut things down if they're not working right. Also, if you get into something and you realize there's 100 other companies they're going after because it's kind of an obvious opportunity, or it's very popular, or it's overfunded. Also have to be, I think, realistic about that, because in the end, the most valuable commodity we all have is our time. And as an entrepreneur, it's easy to get sucked into a passion project that you spend a year on, and you just don't want to let go, and you feel like you have a lot of fight in the dog and you want to keep going, and sometimes it's you need to have that as an entrepreneur, and there's other times where you're barking up the wrong tree, and no matter how much fight you have, it doesn't yield a successful outcome for you or your investors or the people within the company.
Do good and great VCs have to have operating or founding experience?
Now, this is a great debate, because my personal bias would say, as an entrepreneur, I would want to have somebody with great operating experience on my board, and as my investor, that would be my personal bias. And yet, if you look at some of the great investors of this vintage, prior vintages, a lot of them were not operators, and they still managed to develop whether it's pattern recognition or it's the board level skill set or whatever the case may be. They were able to really be very additive and very successful in that role, and they didn't have operating experience. So I think that I want to say yes. I want to believe yes. I'm going to err on the side of bringing on people within 4490 that have that kind of background, because I think it is really, really important. But I think the data probably is not conclusive that you have to be an operator and that you have to be a successful operator, because what the data probably doesn't bear out is all of the hugely successful operators that go into venture that aren't terribly successful. Those either get glossed over or we don't focus on them. So I think you miss some of that data. But I would say, for me, we're going to err on the side of trying to bring more operating expertise, more insights in and around our portfolio companies. And one of the best ways to do that is with the general partners.
So I want to go back to this decision of going from an operator, and real quick point of clarity, where was your business located?
We're based in Phoenix, Arizona.
Okay. So you went up to the coast. I want to know why VC, why the Bay Area, and why Peninsula? Like, walk me through that elongated decision.
So I think some of it, why venture, I think, was probably an easy one to explain. It may not make the most sense, but I think it's easy to explain. I think part of it was there's this belief that when you become a successful operator, there's at least some of us that think, well, the next evolution would be to be an investor. That's what I thought at the time. I don't necessarily share that view today, because I will tell you that probably the most satisfying times that I've had and the most gratifying experiences professionally probably came when I was building, my company, and certainly, have fond memories of that. And so I don't necessarily think there's like this graduation and that happens. And I think that was probably just a view that I had that, again, today I don't probably share quite as much. So that was probably what led me to venture, is like thinking, well, I've done this, now I need to move on and do this other thing. So when I looked around, it was clear, especially at that point in time, that there were a couple of, hot spots for venture. And, oddly enough, it's different than today. Back then it was still Silicon Valley by and large, but it was more, it was the Bay Area, but it was less, San Francisco. And then it was Boston. It wasn't New York, but it was Boston. But I knew if I was going to try to do this, I wanted to try to do it the best I could, and with the best opportunities and the best people and all that. And so the idea of going to the Bay Area and trying my hand there made all the sense in the world, and was fortunate enough to get connected with the guys at Peninsula. And we had a very similar mindset in terms of kind of funding of companies around this idea of capital efficiency and all of that, similar focus on sectors and things of that nature. And so that made a lot of sense. And to be honest with you, I still was an entrepreneur at heart. And so the idea of going to a bigger fund really just didn't feel like that was the natural evolution for me. I'd seen bigger bigger organizations and bigger things, and I kind of just naturally gravitated towards earlier stage, smaller groups. And so Peninsula was a smaller group, and it fit my personality, and I think I felt like I could come in and help build something, and that would scratch a little bit of that entrepreneurial itch that you lose a little bit of when you go on the investing side. And so it was kind of this nice mix for me of working with really good people, good partners, being in a small enough firm where you could help build and make it grow, and then be in a geography and an industry that I thought was going to be really exciting and interesting.
So then tell me, you moved to Wisconsin. You said, I'm going to take what I learned and apply it to a different geography. Why Wisconsin?
Well, during my process of exploring other geographies, the natural places for me, coming from where I was at was, look at places like a Portland or a Salt Lake or a Boulder, Denver, Boulder, something like that, and started to kind of explore and see which one of those would make the most sense, both personally and professionally. And during that process, I got connected with a couple of very large institutions. They're actually based in Madison here. The initial conversations from my perspective were, get to know them and then have them be part of the next evolution of the fund here. I think from their perspective, they were always thinking, well, we have a lot of money, and we think that the real opportunity is, something other than the Bay Area, because both of these investors had a lot of exposure already to California venture capital firms and whatnot. They didn't need more of that exposure, but I think what they saw being here on the ground was that there's a lot of what I would consider now kind of the inputs of innovation that reside in kind of between the coasts. Whether that's engineering grads, whether that's Fortune 500 companies, whether that's domain experts inside of those companies. There's just a lot of those inputs. And then when you look at the percentage of the inputs relative to the amount of capital that's either managed by firms in this part of the country or deployed in this part of the country, regardless of where the firms are based, it was minuscule. And so as I started to compare kind of this thesis of the middle part of America relative to a Portland or even Salt Lake and whatnot, the dynamics were just so different in terms of the inputs to capital. It became kind of a no-brainer from my perspective. And then the investors that I was talking to were great people. They had a lot of money. They had a clear vision of what they wanted to be a part of and fund. And so at that point, then it became kind of a no-brainer to partner up with them, have them be really kind of foundational LPs for 4490, not only for the start, but for the long term. That's a big, meaningful part of the story. And then we got in business, and then we really mapped out our thesis on where we should be spending our time and where we should play. And that was about 5 years ago.
So in engineering, if you go to Silicon Valley for a few years and come back, you demand a premium. In finance, if you go to New York for a few years and come back, you demand a premium. Is it like that in venture capital? Is it easier to raise a fund having had Silicon Valley based experience?
Yeah, without question. I mean, the benefit of being in the Bay Area is the velocity of learning. I mean, there's 10x or 100x depending on where you're coming from, the number of opportunities, the people that have been successful. And so I think the learning is dramatic in the Bay Area, just like it is when you go to New York for finance or whatever the case may be. You just learn so much more at a more aggressive pace that you end up, I think, progressing faster and further and seeing things that you might not be able to see quite as readily in this part of the country. So I think from that perspective, I think people realize that there's value to having had that experience. I think there's value to being able to identify what part of that experience is relevant going forward in our 4490 effort. And then there's value in being able to translate kind of the approach and the attitude and all the things that go along with it and putting that into kind of a non-coastal environment, which is very different. And so there's not a lot of people that have been on the coast and then have come to the middle part of the country. And so, for better or worse, I don't sound like or look like or appear to be, like a lot of the folks that, the LPs probably talk to.
How big was that first fund that you started in 2014?
Yeah, so our first fund was just me, and it was a $30 million kind of sole GP fund. And then we raised fund two. I brought on a partner, and we doubled the fund size a little bit more than that. So about $65 million for fund two with the second GP, with the idea that we kind of systematically grow over time with adding kind of one general partner and trying to get to kind of a steady state of, call it $40 million per partner per fund, which we kind of think is kind of the right number for the type of investing that we do in this particular geography.
What types of assumptions did you have in that first fund about opportunities or companies that you could find that proved to be true?
I think, we certainly had an assumption on kind of the profile of an investment, and from a pricing perspective, and then also from an efficiency perspective. We expected companies to, I would say my assumption was probably we'd be about half the price for valuations. And we also felt like if you looked at the cost of engineers and personnel and everything else, office space and all the kind of the more major inputs into building a company, at least the first 3 or 4 years, we'd be kind of, not quite half the price, but maybe 60 cents on the dollar. And I think that's largely proved out. And so that was the biggest, one of the big assumptions that clearly proved out. We had other assumptions that I think we maybe didn't quite prove out exactly the way that we thought. And there's probably some things, and there were a handful of things that we had hunches on that we had to kind of work out over, the first year or two.
What were some of those things that didn't prove out, or at least not to the degree that you expected?
The first one is probably the number of people that have been part of a high growth software company that has gotten to critical mass and had some real size and heft to it, and hopefully some exit, is fewer and farther between than I would have hoped. We knew we'd have to be kind of early days helping the entrepreneurs in all the normal ways and whatnot, but when you get to $5 million or $10 million of revenue, that then you can start to bring in some other people that have different skill sets that can help take that company from 5 or 10 to 50 to 100. And those people are just incredibly hard to find around here because there just hasn't been a lot of successes. There's getting to be more and more. That's the good news. And there are people out there, but it's just those people are in high demand, obviously. And there's such a shortage of them, it makes it hard. So that was probably the big thing. The other assumption we had, whether we kind of thought about it explicitly or not, was kind of just the notion of expectations of the founder. And I think that right, wrong, or the other, in the Bay Area, people are overconfident. Everybody thinks they're going to build $1 billion business, and they're not going to settle for anything less than that. I think in the Midwest, people haven't seen $1 billion companies being built. They don't feel like they need that to be able to buy a house and, have a lifestyle in California. And so for them, if they can build a company and sell it for $50 million, they haven't seen that before. That would be huge. And so there's a little bit of a trying to elevate the founders' vision and expectations for what they can and should be doing, and also understanding that if you build something and you get some traction, and somebody very early in the life of the company comes in and says, I'm going to give you $50 million and take you off the table early, that sounds, I think, great to a lot of young founders in this part of the country. Whereas I think a lot of people realize that, that's flattering, that's interesting. Maybe it's the right idea and you should take it, but maybe they're offering that because they see that there's a much bigger opportunity, that if you stick with this for another 5 to 8 to 10 years, because these things do take a long time to build, that there could be something much more material on the back end. And so that's the other piece, that just working with the entrepreneurs, making sure that you back the ones that have the bigger visions, and then continue to help them execute against those visions, and even try to expand those things to where they can see a broader opportunity set, maybe an expansion of their skill set and comfort zone, so that they want to go after kind of that secondary opportunity or that bolt-on opportunity or whatever the case may be. And so it ends up being kind of a bigger part of the filter than I think in the Bay Area, where it's a foregone conclusion that everybody's overly ambitious, overly confident, and a lot of times you have to try to moderate that a little bit to get people back to something that might be more rational.
Where do you invest? Like, how far away will you go from Madison? How does your geographic footprint?
Yeah. So I think like most investors, if we could have an entire portfolio where we could walk to our portfolio companies, we would love that. And so we try to do every good deal we can in Wisconsin. We try to manufacture or move companies to, just like everybody always has done. And so we'll do that just like everybody else. And then as time goes on and I would say as our reach expands with, new people involved with 4490 and with the network expanding, we go farther and farther afield. So, I'd say most of our activity has been, if you look in the rear view mirror, has been kind of upper Midwest. So those 8 or 10 states that you normally associate with the upper Midwest. I would say that if you look at what we're doing going forward, it includes all of those states and, probably the other 10 or 15 states that you can kind of start to see things happening, whether that be Colorado and Texas and Georgia, places like that have, nice tech hubs that would make a lot of sense. But you have to be thoughtful about where you're spending time and where you're investing, because you do want to be able to have those frequent and meaningful exchanges with those entrepreneurs in the early days. And, getting on a plane, especially if it's not a direct flight, is, ends up being a huge hindrance to having those types of relationships. And so you have to just be really thoughtful about all that stuff. But we'll kind of go, our belief is we want to get the best investments we can kind of outside of the coast, because we just believe that, the capital dynamics outside of a few select places in that region are, very similar to what we found, kind of here in the upper Midwest.
When you're investing, how are you investing? Are you leading rounds? Are you joining?
Yeah, so that's part of the strategy that, back in 2014, when we started 4490, we knew we wanted to be early stage, but what does that mean? Does that mean seed? Does that mean Series A? Does that mean earlier or later than that? Does that mean, a whole bunch of investments and seeing what works and then piling on? And really, this was born out of talking to the customers, the entrepreneurs, looking at what's available and what other people are doing, and trying to find a place where we can play the most meaningful role in the ecosystem that we can. And what we believe the biggest need is a active lead significant Series A investor that can write a meaningful check. Because if you do look around this part of the world, there's a fair amount of money. It's not always sophisticated angel money. It may not be organized in the best ways, but there's a fair amount of money, and a lot of that money is more and more interested in technology-based efforts than ever before. And so if you're a really good entrepreneur, the ability to raise $1 million to $3 million of seed money is pretty, I don't want to say easy, because it's always hard, but it's doable, and it's, that's not the hardest part of this. And then the other piece of it is we felt like once a company gets to $5 million, maybe $10 million of revenue, the number of funds that want to come from the coast to write those bigger $15 to $30 million checks, those dollars will travel quite easily, because those companies are much more stable and predictable, and just give those types of investors a lot more comfort that they don't have to be as close to those. And so what we found is, if you're an aggressive entrepreneur solving a complex problem in a big market, and you need to raise a fairly large Series A, large by non-coastal standards, if you're trying to raise $6 to $12 million in a Series A, to give yourself the capability to really build out something significant and hit some real meaningful milestones, there's just not a lot of people that want to write that big of a check, that want to lead and price that round and do those types of things. And so that's where we felt the biggest hole was, the biggest opportunity. And so rather than doing a bunch of seed deals, we focused exclusively on lead Series A companies where, we can have, material ownership, material impact to the company, both in terms of writing them a big check, but also bringing together the syndicate, helping them with all the normal issues and challenges that they're going to face, and giving them enough runway to get to that next big milestone where you can attract the outside, coastal investor.
That is the plight of so many of the companies that we hear on this podcast. So what are the first couple of filters that your team goes through when evaluating one of those lead Series A deals?
Unlike a lot of people, we're not terribly motivated by revenue. I think there's some people that feel like revenue is really the only thing they need to focus on. And if you have X, then we're in type of thing. For us, we really focus on, what is the problem that you're trying to solve? Is it a complex problem? Is it protectable over time once you expose your business to the broader ecosystem? And are you going after a big enough market with people that have the money to buy that, so you have the right type of dynamics? So if you're a pre-revenue company, but you have those things going for you, and you're a credible team, again, that has kind of the appropriately sized vision and outlook on things, that has the capability to be kind of uniquely qualified to do this or solve this particular problem, that gets really interesting to us. We tend to, while we wanted companies to be really capital efficient in the early days, sometimes that can be, you can be really capital efficient, but that's because you're in such a small niche that it's easy to build a simple product and get out there and get to a couple $1 million in revenue, but that your upside is really capped. So it's really trying to balance the need to be efficient with your dollars and get way down the field with those dollars, but really being focused on a big, complex solution and having some product insight that others just won't have.
How many deals are you guys evaluating, like on a given week?
So we do, we can kind of back into this. So we'll do 1 to 2 new investments per person per year. So we run a very high conviction, high concentration portfolio by design. Kind of allows us to have more time, more effort, more money for a fewer number of companies that we hopefully can have a more material impact to. So that kind of allows us to have a slightly different filter or view of things, because of you're only looking for 1 or 2 per year. It gives us the luxury of being, I think, more selective than we otherwise would be. But I would say, we try to do a good job of clearly articulating what looks like a 4490 investment, what we're looking for, and that obviously changes over time as trends and markets change. But having a clear understanding of that, so that we can quickly look at lots of opportunities and not waste a lot of the entrepreneur's time or our time unless they have kind of these clear things. So I would say that we look at probably just back of the envelope. It goes from year to year, but I'd say we probably see call it 1,000 opportunities a year, which there's probably even a filter of things that we have before we get there, but like 1,000 that you spend a little bit of time with, and then we quickly get to ones that are maybe 100 of those are kind of pretty interesting, that you have more in-depth meetings with, and it's probably only 25 of those that you get kind of really serious with, and you want to close on a handful of those by the end of the process.
On the other side of the table, you mentioned that going forward you'll probably add more partners, and there'll be this $40 million per partner thing as you grow. How do you think about, and what's your process for adding a new partner? Because that's a pretty big investment as well.
Yeah, it's a huge investment, and it's really hard because it is such a small partnership, and so each person has a material impact in kind of the direction that you go, and there's there's a whole bunch of other things that make the kind of the sequencing of finding the partner hard. So I would say by and large, I'd say it's probably true of a lot of firms. Typically, future partners end up being in and around your ecosystem in one way or the other, whether that's somebody you backed before, or an operator from a company that you backed, whether it's a co-investor that you got to know, whether they were at a different fund or maybe investing on their own account. But somehow you got to know them over an extended period of time, and kind of, because the most important thing is you want to make sure that they share a lot of the same philosophies and can be additive to the strategy that you're going after and trying to execute. But then there's the dynamic of it's much like the entrepreneur trying to evaluate an investor. We have to kind of do the same thing. It's a long-term marriage, and so there's an interpersonal fit that becomes very, very important as well. And so having that time, that, usually multiple years to kind of develop those types of relationships and that type of, insight into the type of person that you're looking at, it's such a very time consuming process. But it's something that, I think you're always on the lookout for, who could fit that role. And 9 times out of 10, the timing doesn't work out. They're on to starting a new company or on to next opportunity before you can make something happen. And so you have to kind of be thoughtful of always being looking and just kind of waiting for the right time and right place for all this to happen.
Well, we've kept you a little bit over time here, Greg. So one last quick question from me. Where did the name 4490 come from?
Yeah, so this is an easy one. It's, as you know, it's really hard to name venture firms and have them not either sound kind of completely ridiculous or just sound like another rock or tree. So we went with the latitude, longitude of the center of the state of Wisconsin as a way to have something different that usually begs people to at least ask the question. And then hopefully they remember us as a young fund. You're always looking for ways to have people kind of remember you and differentiate you from the rest of the folks out there.
Awesome. Well, if people want to learn more about you or 4490 after the show, where should they go?
Just go to 4490ventures.com is our website, and they can also get a hold of me at gr@4490ventures.com. Love to talk to everybody, and hopefully we can be efficient with our time and your time and have a good conversation.
Eric, one of our favorite questions is what sucks? And do you know what sucks about podcasts?
The fact that we don't know who's listening to us.
Exactly. The analytics in podcasts are terrible. And so I think I came up with a solution of how we can get a better feeling for who our listeners are.
Well, do tell.
All we need you to do, dear listener, is go to upside.fm/survey and answer a short 1 to 3 minute survey so we can get a better understanding of who you are, which helps us serve you better. We love feedback on the podcast, don't we, Eric?
Oh, we love feedback. All about the feedback.
All about the feedback. And so if you would humor us, please go to upside.fm/survey. Let us know a little bit more about you so that we can better serve you and make this podcast even better. That's upside.fm/survey.
We promise the survey won't suck. And now for an Upside Classified read. Each year, M25 compares the 54 largest tech ecosystems across the Midwest with its Best of the Midwest Startup Cities rankings. For those who don't know, M25 is a VC firm that has about as much authority as anyone to put this out. They've backed 90 plus different startups in the past 4 years across 24 Midwestern cities in 11 states. These rankings compare 24 unique variables ranging from the number of startups in a given city, to the quantity and quality of its accelerators, to the strength of their university ecosystem. Unsurprisingly, in 2019, Chicago came out on top, and that was by a wide margin. But what about the rest of the top 5? Minneapolis, Pittsburgh, Indianapolis, and St. Louis. Is that surprising? Well, the big surprise for me was seeing the lack of Ohio representation in the top 5. I was happy that all 3 of Ohio's major cities came in the top 10, whereas every other state's top ecosystem is concentrated only around one top 10 city. While all rankings should be taken with a grain of salt, this one should help drive some important conversations and give local tech organizations a yardstick to compare themselves against their peers. To learn more, go to midweststartups.com. If you want to have your ad read on the Upside podcast, go to upside.fm/classifieds. All right, Jay, we just spoke with Greg Robinson from 4490. And you know what trips me up?
Words?
Yeah, frequently. Specifically names when they're names of other people. So Greg Robinson is an offensive lineman for the Cleveland Browns. And I obviously had that picture coming into this interview. This Greg Robinson is a very different human being.
You expected our guest today to look like an NFL offensive lineman?
That's exactly what I expected in my head. Subconsciously.
All right.
But I told myself that's ridiculous. And I was still wrong. Anyway, we had a very Gregorian chat.
Oh, wow.
It's not even the proper use of that term. But I need to segue somehow back out of the offensive line chat. So here we are. We're just going to jump right in. what were your takes on 4490?
It was a bigger firm than I realized. They raised a $30 million Fund 1, having started in 2014, which I imagine was very difficult. They've now more than doubled that in Fund 2. I really liked Greg's, I'm going to say humility. Like, I just felt a lot of humility in the way that he presented himself. And he brought it up in the beginning of the interview, which was basically, I had some success early. I was overconfident. And that theme came up several times. It's like, yeah, I was young and overconfident. And you could feel this sense of how far he's come since being overconfident. And maybe investing in the Midwest since 2014 does that to you. But I was surprised to hear how big the firm was, encouraged to hear the willingness and the interest in some of the institutions in Madison when you're starting to look around, because he was looking at Portland and Seattle and Boulder. And Madison seemed to get it from an institutional perspective. They said we had exposure to California already. We wanted to get more things here. We see the inputs of innovation here. We want to invest here. And I'll stop there and get your response to that.
Do you have any understanding of like the distribution of fund sizes in the Bay Area? Because I don't really know how big fund sizes are in the Bay Area. I know you have your top tier funds that are huge, and you have a lot of micro funds that are just throwing angel checks around. But it feels like in the middle of the country, this 50 to 100 million kind of space is the most saturated.
Interesting. No, I don't have that sense. And I do think you're right. Although we frequently come across on the show guests or former guests of ours who are looking for someone to lead their Series A and really struggling to find that in the middle of the country. And Greg said, yeah, we lead rounds. We invest 5 to 8 million per investment. So I guess I do hear anecdotally that, I don't know, is that what's available here? I feel like Series A is where a lot of people fall flat here in the middle of the country.
I would agree, but I think as a percentage of VCs, it feels like majority of them are in that 50 to 100 million space for some reason. And I don't know how that translates to, maybe it's because there's such a high number of 50 to 100 million dollar funds that there are so few of them that the Series A gap is still in existence, but there are a few people who are doing it. I don't know. It's maybe an anecdotal thought from my perspective, but that just seems like the fund size in the Midwest and the middle of the country in general tends to either be from 50 to 100 million, or it's someone who tells us, yeah, the next fund that we raise, we want to be 50 to 100 million. It just seems like the economics of the middle of the country tend to steer venture capitalists to this range for some reason.
Something that Alex Rubalcava told us in our interview with him of Stage Venture Partners that connected some dots for me for the first time was he described venture capital as a capital constrained asset class. Like, you can only invest so much before it becomes impossible to deploy that much capital and have the model still work. And so I'm wondering if some of these funds that are that size are just some of that leftover capital that can't make it into some of these bigger West Coast funds that they want to put them into. And they're saying, well, we want to get venture asset exposure somewhere. Let's collect it in some of these new handful of funds that are reputable here in the middle of the country. I don't know. This is all speculation at this point.
Right, but we've talked to a good number of venture capitalists, so I think the speculation is at least guided, if maybe misguided, but it's definitely guided in some capacity.
Well, by that logic, any speculation would be guided if misguided also counts as guided. I like when investors on the show break down the way their funnel looks. You said they look at 1,000 companies per year. 100 of them may be interesting. 25 of them may get in diligence and they'll close on a handful. I like that insight. That's new to me. And I also really liked his perspective on capital efficiency. And capital efficiency in the middle of the country probably is almost cliche at this point and maybe even gets a bad name in a lot of ways. But his point was, when you have too much capital, you don't have to make hard decisions as often, and it leads to bad discipline down the road. So he thought that being capital efficient leads to smaller, cheaper mistakes instead of lots of expensive mistakes, and it facilitates a culture where you need focus and put high value on decisions. I like that perspective a lot.
And I like the idea of connected software. So having a hardware component and software component. I don't think we touched on it too much in the interview, but I think it's a unique differentiator for firms that typically invest in pure software or firms that invest in hardware or firms that invest in products. I think it's a unique thesis that 4490 is thinking about.
All right, dear listener, we'd love to hear what you think about this episode with Greg, who is not the offensive lineman for the Cleveland Browns. You can tweet at us at UpsideFM or email us hello@upside.fm and let us know what we missed, where we hit right, where we're wrong, and we'd love to hear from you there. Talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on rhyming.